This is Chapter 9, Inventory Costing and Capacity Analysis, and this is Part 2, Capacity Analysis. So far, what we did was we looked at variable costing, absorption costing, and then throughput costing, and looked at the sort of the effects of them, but we really won't know it until you work some problems. All right, the problems are really important here. So now we focus on the various capacity concepts that firms can use in absorption costing. All right, we'll examine the key factors that managers use to choose a capacity level and to compute the budgeted fixed manufacturing cost rate, and then understand other issues that play an important role in capacity planning and control. So the key question regarding denominator level capacity is this: given a firm's level of spending on fixed manufacturing costs, what capacity level should managers and accountants use to compute the fixed manufacturing cost per unit? Okay, and that's why it's a big question. Spending on fixed manufacturing overhead enables firms to obtain the scale or capacity needed to satisfy the expected demand from customers. So determining the right amount of spending or the appropriate level of capacity is one of the most strategic and most difficult decisions that managers face. It's a long-term decision. Okay, you don't just flop in and out of investments in fixed assets. Now, too much capacity means that firms will incur the cost of unused capacity. Having too little means that demand from some customers may be unfulfilled. So let's take a look at the capacity levels. A couple things here. The capacity ordinarily is a constraint or upper limit. Okay, and that the choice of capacity level used to allocate budgeted fixed manufacturing costs to products greatly affects operating income. That's the issue here. So as we know, the choice of capacity level used to allocate budgeted fixed manufacturing costs to products can greatly affect operating income. 4 different capacity levels can be used in the denominator to compute the budgeted fixed manufacturing cost rate. We've got theoretical capacity, practical capacity, normal capacity utilization, and master budget capacity utilization. So for theoretical capacity, this is the level based on producing at full efficiency all the time. Which doesn't happen. That's the problem. It is theoretical in the sense that it does not allow for any slowdowns due to plant maintenance, shutdown periods, or interruptions because of downtime on the assembly lines. Theoretical capacity levels in the real world are unattainable, but what they do is they represent the ideal goal of capacity utilization that a company can aspire to. So this would be something that even employees could see and see how close they were to really utilizing the capacity. Now, we already know that both engineering and human resource factors are important when estimating theoretical or practical capacity. Engineers can provide input on the technical capabilities, while human resources can evaluate employee safety factors, such as increased injury risk, where the line operates at faster speeds. So practical capacity is the level of capacity that reduces the theoretical capacity by considering unavoidable operating interruptions. Okay, like, I lost my, I wanted to just make it bold. Darn it. Scheduled maintenance time, shutdowns for the holidays. I mean, these are things that are just going to happen. So both theoretical capacity and practical capacity measure capacity levels in terms of what a plant can supply. The next 2 levels measure capacity levels in terms of demand. So we're turning now to the next 2 types of capacity. Normal capacity utilization is the level of capacity utilization that satisfies average customer demand over a period that's long enough to consider seasonal, cyclical and trend factors. Okay? Master budget capacity utilization is the level of capacity utilization that managers expect for the current budget period, which is normally 1 year. These two capacity utilization levels can differ significantly in industries that face cyclical demand patterns. So this is the effective choice of capacity on budgeted fixed manufacturing overhead cost rate. And as you can see from this chart, choosing between the capacity levels, so here we've got theoretical, practical, normal, and master budget. Here's our budgeted fixed overhead, so that's the same. Here's the capacity level. So for master budget driven, it's 8,000. For theoretical, 18,000. And this is the difference in the budgeted fixed manufacturing overhead costs. So the range is from $60 per unit to $135 per unit. So remember too that you're adding this cost per unit to the variable manufacturing cost per unit to obtain a total budgeted manufacturing cost per unit. So how should a company choose the capacity level to use? What do they do? Darned if I know, huh? So we just discussed the various capacity levels. Now we're looking at how to choose the appropriate one for a particular purpose. We'll review the process for 5 different purposes, including product costing and capacity management, pricing, performance evaluation, external reporting, and tax requirements. And see, that's what we're doing. What cost or what level you use really depends on what you want to use it for. So theoretical capacity is rarely used to calculate budgeted fixed manufacturing cost per unit because it departs significantly from the real capacity available to a company. All right, I mean, it's really out there. Now for product costing and capacity management, using practical capacity as the denominator level sets the cost of capacity at the cost of supplying the capacity, regardless of demand for the capacity. Okay, so highlighting the cost of capacity acquired but not used directs managers' attention toward managing unused capacity. So in contrast, using either of the capacity levels based on demand hides the amount of unused capacity. Okay, so it really depends probably on your situation and what you want for management. Now the downward demand spiral for a company is important to understand. It's also called the death spiral. Before determining the best capacity level for pricing decisions. It is the continuing reduction in demand for its products that occurs when competitor prices are not met. Okay, demand drops further and the fixed costs are spread over fewer units, resulting in greater and greater costs per units. Okay, and I think it really is the death spiral. Practical capacity, by contrast, is a more stable measure because it calculates the fixed cost rate based on capacity available rather than capacity used to meet expectations. Okay, so it's tied to expectations too. For performance evaluation, it is often best to use master budget capacity. Okay, now this is for performance evaluations. So if you've got a manager that gets paid based on operating income, it's best to use master budget capacity utilization since that most closely holds managers accountable for what they have control over, which is important to the individual. In this case, where there are large differences between practical capacity and master budget capacity utilization, that difference is often classified as planned unused capacity and is shown as a separate cost on the financial statements. Can't say I've ever seen it, but I'm sure it's there. Now the production volume variance will be affected by the choice of denominator level used to calculate the budgeted fixed manufacturing cost per unit. Okay, and that's what we're talking about here is the denominator. Remember from Chapter 4 that is the production volume variance can be disposed of in three ways. We could adjust it, use an adjusted allocation rate approach, recalculate at year end. It could be prorated and go to work in process. It could be written off to cost of goods sold. Okay, those are all options. And the objective in choosing the method is to dispose of the production volume variance is to write off the portion of the variance that represents the cost of capacity, not used to support the production of output during the period. Okay. Remember that production volume variance is budgeted fixed manufacturing overhead minus fixed manufacturing overhead is allocated using budgeted cost per output unit allowed for actual output produced. Good grief. We'll look at this again. We've got to go through a detailed example of this, okay, to really see it. And as we see here, the IRS permits the use of practical capacity to calculate budgeted fixed manufacturing costs per unit and allows for the write-off of the production volume variance against the allocation. And the tax benefit can be significant. Okay, last slide coming up here. For planning and control costs, other issues. There are factors, these factors are important and should be taken into account when planning capacity levels and deciding how to best control and assign capacity costs. Additionally, it is important to understand that costing systems such as normal costing or standard costing do not recognize uncertainty the way managers recognize it. A single account rather than a range of possible amounts is used as the denominator level without calculating the budgeted fixed manufacturing cost per unit in absorption costing. Okay, let's do a bunch of problems here and you'll start feeling better about this. You'll have a more tangible feel about what it means.